Cryptocurrency is no longer a digital curiosity. It's moved into the financial mainstream. About 28% of U.S. adults now hold some form of digital assets. Major financial firms and banks are increasingly offering crypto to their clients. And a growing number of merchants and businesses accept crypto payments. Despite lingering concerns about volatility, scams, and lax regulatory oversight, digital currencies have evolved from a speculative niche into an increasingly accepted form of currency. I'm Herb Weisbaum, the Consumer Man, a contributing editor at checkbook.org.
Welcome to Consumerpedia at checkbook.org. We're the nonprofit that helps consumers select services, avoid trouble, and save money. Because we don't accept any advertising or take money from any business we recommend, you can rely on checkbook.org to be completely independent and objective. Now, here's the host of Consumerpedia, America's consumer expert, the Consumer Man, Herb Weisbaum.
In this episode, what is crypto? How does it work? And why are people buying a currency that's virtually unregulated? We'll also explain meme coins and stable coins. Plus, is crypto really as secure as we're led to believe? Spoiler alert, it's not. We have two experts to discuss all this. Amanda Fisher, Policy Director and COO of Better Markets, a nonprofit, nonpartisan organization that promotes the public interest in the financial markets and tries to make our financial system work for all Americans again. Before that, she served as Chief of Staff at the Securities and Exchange Commission, so she has an extensive knowledge about investments.
Hi, thank you so much for having me.
And Corey Frayer, Director of Investor Protection at the Consumer Federation of America. Corey also worked at the SEC as a senior advisor. His focus was on financial stability and crypto asset markets. Prior to that, he held key positions on the Senate Banking Committee. Hello, Corey.
Hi, thanks for having me on.
We all talk about cryptocurrencies if we understand what it is and how it works, but let's be honest, we really don't. Most have heard about Bitcoin, the most popular form of digital currency, and that's about it. So in lay terms, Corey, what is cryptocurrency and why was it created?
Cryptocurrency started out as sort of a response to the 2008 financial crisis, as this idea that people needed to take power of the financial system away from the regulators, the Wall Street banks, and others that had failed them when we bailed out the folks that caused the financial crisis and really didn't do anything to help the regular people affected by it. Now, what crypto has become is essentially a machine where money goes in one side and political bribery and money laundering comes out the other. It is essentially a digital currency that's created out of thin air. It is hard to trace. The people who trade it are basically anonymous, and its value is based on sort of this public fervor about the technology itself.
And Amanda, it's not regulated like banks and credit card companies and really has nothing backing it up, right?
There is no underlying asset behind a cryptocurrency, unlike, say, stock, where you are getting a claim to the future profits of a company. With a crypto asset, you're really just buying into an idea, a meme, an image. But I will say that while crypto is not currently complying with regulations, there are long-standing laws dating back to the Great Depression for which crypto should be complying. And the Biden administration did try to bring crypto firms into compliance. They strongly resisted those efforts. And now they are before Congress trying to retroactively amend laws to fit their business models such that they don't have to comply with regulations.
I always hear people say digital currency is safe and secure because of the blockchain, whatever that is, the encrypted technology that makes all this possible. It's difficult to alter or hack. All the transactions are public, so anyone can verify them. Is that right?
Well, it's complicated. First of all, most crypto users that are transacting in cryptocurrencies are not doing so on a blockchain. They're accessing these products through big intermediaries that call themselves exchanges, like Coinbase or Binance. And when you interact with an intermediary like that, they are just changing entries in their internal databases saying that Amanda sold 10 Bitcoin and Corey bought 10 Bitcoin. There's no blockchain involved. So much of the original promise of cryptocurrency was the blockchain. It was being able to transact without a centralized intermediary in the middle that could censor or surveil your activity. But today, most of the activity does not occur on a blockchain, and all of these firms have sprouted up to basically reinvent the wheel of exchanges, broker-dealers, banks, and all the sort of trusted intermediaries that we come to rely on when engaging with the financial system.
Corey, I would assume that thousands of people control the blockchain, right?
Well, that's what the industry says, and that's what they want you to believe. But the fact of the matter is, sort of even what you might consider the most quote unquote decentralized blockchains, in fact, have huge centralization and are typically controlled by a very small number of people. I think even the industry would agree that Bitcoin is sort of the prime example of a decentralized, community-run blockchain that requires many, many people on the network in order to keep it operating, and therefore has very little control by small groups. Now, the fact of the matter is, there are 4 developers, the only 4 people in the world that have the ability to send updates to the blockchain software to propose changes. So that is an enormous amount of power over that network in the hands of just these 4 people. You look at the other large crypto assets, Ethereum being the next largest, and the Ethereum Foundation and Vitalik Buterin have enormous control over the development and changes of that blockchain. And even further, when they shifted to this, what's called a proof of stake mechanism, which essentially means that the folks who have lots of Ethereum are in control of which Ethereum transactions take place, you have seen, again, this centralization of the power in the blockchain into a small number of very, very wealthy people.
People who could be blackmailed or bribed or who could just decide on their own to do something nefarious.
These people exercise enormous control over these networks. Some of them may be state actors working against the interests of the United States, facilitating money laundering, facilitating political bribery. Some of them may just be attempting to manipulate transactions for their own gains. A number of the validators are able to profit off of charging fees for their transactions. And so they have many opportunities through their power to benefit more than the regular users. And then, as Amanda mentioned, you have these large companies that have sprung up. The largest platforms are very centralized and often exercise a lot of power over the operation of the blockchain. They do a lot of Bitcoin mining, which is how they validate those transactions. And so there's enormous concentrations of power. Even the Trump family owns a very large and powerful Bitcoin mining network. So the fact of the matter is, regardless of the promise and the marketing of these blockchains as decentralized, the fact is they're very centralized, in most cases far more centralized than even our current financial system.
And of course, then there's the issue of hack attacks. No matter how secure the blockchain may or may not be, it doesn't mean that criminals can't steal crypto that's stored on your digital wallet or with one of these third-party companies that you guys have been talking about. I looked it up. There have been at least 10 crypto exchange hacks of more than $100 million, according to Crystal Intelligence. And earlier this year, criminals siphoned off $1.4 billion in a digital currency called Ethereum from a Dubai-based crypto exchange called Bybit. It was the largest single theft of crypto in the industry's history. I think that's something people have to realize. It's digital. Anything digital can be hacked, right, Amanda?
Absolutely. Part of what makes cryptocurrency such an attractive honeypot for hackers is not only the ease with which it can be stolen, but the ease with which it can be laundered once it is stolen. So there exists services online called mixers or tumblers that allows users to plug their cryptocurrency into this internet application, essentially clean the internet history of where that money came from, and obfuscate movements of the funds. So, if you think about traditional money laundering, if you've seen Ozark, the guy opens up a resort in order to hide the proceeds of a criminal enterprise. There's now just software that can do this. And the cryptocurrency industry has been very successful at rebuffing U.S. law enforcement attempts to shut that software down. So again, with the Bybit hack that you mentioned, $1.5 billion was stolen. But not only was it stolen to fund the North Korean nuclear missile program, but it was able to be laundered very quickly using these mixer tumbler services. so that the hackers could abscond with the funds and it would be outside the reach of law enforcement. And this can happen within minutes. So by the time that the crypto exchange or law enforcement realizes that it's gone, the proceeds are already taken offshore and irretrievable.
So just to recap, crypto is basically popular with criminals who are using it to move money around, people who want to avoid government regulation or avoid tax consequences, and then the rest of it, a little percentage is used by people who think it's really cool to invest and make it rich and may lose a fortune. Is that a pretty good summary, you guys?
I think so. I'll just add, if you're familiar with ransomware attacks,
Yes.
which are attacks on companies, hospitals, public utilities, schools, you name it, where the hackers hold a software system or a power system or an electrical grid hostage and demand a bribe to let the hostage go. 98% of those attacks are funded using cryptocurrency, meaning the hacker demands the bribe in the form of cryptocurrency. And the crypto industry will like to say, well, people launder money with cash, they launder money with artwork, Rolex watches, cases of wine. But I think it's important to note that all those items are physically bulky and hard to carry around, and it requires a large network of people to do the money laundering. So there's a reason that ransomware attackers demand payment in crypto and not watches or artwork.
Good point. You know, when it comes to crypto, we're in what feels like a modern day gold rush, where some people will get rich and some will lose everything. And we're going to talk about that next. I'm Herb Weisbaum, the Consumer Man, and this is Consumerpedia, powered by checkbook.org.
At checkbook.org, we have the answers to your consumer questions 24/7. That's checkbook.org. We're a unique nonprofit that can help you with select local service providers, avoid trouble, and save money. Because we don't accept any advertising or take money from any business we recommend, you can rely on Checkbook to be completely independent and objective. Our advice is always free. Ratings of local services are available with a subscription. If you live in one of these 7 metro areas and haven't joined Checkbook yet, check us out. Boston, Chicago, Philadelphia, Seattle, San Francisco, Minneapolis-St. Paul, and Washington, D.C. Get your free 30-day subscription by going to checkbook.org/Consumerpedia.
In just a few years, crypto has gone from a fringe internet experiment to something you hear about on the evening news and see in your banking app. Big investment firms and banks now offer Bitcoin funds. Payment giants like PayPal and Visa make it easy to spend or store it. And apps like Venmo let you buy a few dollars worth with the same tap you'd use to split a lunch bill. Whether it's your cousin bragging about a new token, a Super Bowl ad for an exchange, or Bitcoin prices scrolling along with the Dow on CNBC, crypto has worked its way into everyday life, even if plenty of people still aren't sure exactly what it is or how it works. The crypto craze is also powered by the potential for enormous riches. In 2010, when the first exchange opened, a Bitcoin was valued at about 3 cents. Today, a single Bitcoin is worth $122,000. So, Corey, why wouldn't I want to get on this action?
It's important to remember that crypto isn't really an investment. Crypto is as much an investment as betting on next week's Indianapolis Colts game. So it's important to realize sort of the distinction between growing your money based on companies that contribute to the overall growth of the economy and sell real goods and services, and this digital technology that's kind of made out of thin air and where you have to trust whatever the creator says rather than having verifiable information about your supposed investment. Now, there are these traditional vehicles that we've seen crypto sort of creep into, like exchange-traded funds. And that makes it seem as though these could be safe investments because they come with this small number of regulations. But the fact is, those funds have the same vulnerabilities to hacking. They're subject to the same concentration of the crypto markets. They have all of the volatile qualities of that broader, non-compliant ecosystem with the veil of safety. There's really not a safe way to quote unquote invest in crypto. Now, when you talk about seeing other people get rich, that's just the law of big numbers. There are always going to be winners. There are always going to be losers. But if you take a look at who's winning in this space, take, for example, the Trump meme coin. About 50 people who invested in that meme coin made money, and they made millions of dollars. About 750,000 people who invested in that meme coin lost money. And so you really have to think about, do you really have a chance in this marketplace that doesn't have the same protections, doesn't have the same rules of fairness, doesn't have the same oversight as the kind of investments that track the broader economy, the kinds of investments that are subject to those protections that we established after the 29 crisis and the Great Depression, that we established after the 2008 crisis?
Amanda, he used the word volatility a couple of times. People need to realize that it doesn't always go up. It can drop precipitously. And if you need that money for some reason, you could lose a fortune.
Yes, it is not uncommon to see 20, 30, 40, even 50% price swings in the price of Bitcoin over the course of a day. And I would say that Bitcoin tends to be one of the less volatile cryptocurrencies out there. Another thing that I think is really important to keep in mind is that there is also not the market surveillance and law enforcement that exists in other markets. Certain individuals could have huge positions in cryptocurrency, and then who knows, maybe they use subterfuge techniques to spread internet rumors to change the price of Bitcoin, or they fake press announcements from major retailers saying that we're going to accept Bitcoin now as payment, or they hack the SEC's Twitter account and say that certain new Bitcoin-based products were approved. These are all things that happened, which means that outside actors can influence the market to change the price of Bitcoin, and it is very, very difficult, if not impossible, to find the culprits behind that behavior, as the SEC could in, say, insider trading cases in the stock market. Not only is there volatility, but there's also really not a lot of reliability that the market reflects the innate behavior of buyers and sellers.
So for someone who just wants to play with some funny money they may have that they'd go to Vegas with or something and get into crypto, and realizing all the things we just said about all the inherent dangers, is there a safer way to do that? Would it be the exchange traded fund through some big brokerage house or something? Is there a better way to do it if you're going to do it knowing you could lose all that money?
I mean, Corey spoke to the exchange traded fund point earlier. I would say with regard to those products, there is still no regulation of the underlying asset that undergirds the exchange traded product. So the wrapper of the product is regulated on, say, the New York Stock Exchange or NASDAQ or other exchanges. So there might be a slight enhancement for the regulation, but really when the underlying collateral of Bitcoin is not regulated, it's not going to buy you much in terms of getting the product inside of an exchange traded wrapper. Individual investors, I would say, treat any cryptocurrency investment like you would any sort of budget for sports betting
Right.
or gambling. It's only put up what you can afford to lose. This should not be the basis of your nest egg. You should not rely on it for retirement. But if you have disposable income that you can essentially play and speculate with, sure. I fear that the cryptocurrency industry is painting the asset class much more like stocks or bonds than they are sports betting.
Good point. Which brings us to President Trump, who in 2021 told Fox News that Bitcoin, quote, seems like a scam. Now he says he wants to make the U.S. the crypto capital of the world. This summer he signs an executive order that could make it possible for Americans to have their retirement savings invested in cryptocurrency. Corey, does that concern you?
It's really concerning. I think we've covered why these kinds of investments, even for, your typical investor that has a brokerage account and isn't relying on this for their retirement, are risky, are generally just gambling. And so to say that these highly protected employee-sponsored plans, the plans that have a fiduciary duty attached to them, should be made subject to a quote-unquote investment that has incredibly high fees, non-transparent fees, that has enormous volatility, that doesn't have any real basis for growth in the real economy. It's incredibly dangerous, and it is hard to imagine how a plan manager would ever justify putting this kind of product in retirement savings accounts. And I really fear the consequences of what happens when people are exposed to these volatile assets in an account they rely on to feed and house themselves through their retirement.
It's important to remember that these employer-sponsored plans like 401ks are also tax advantaged. So what the president is really doing is trying to put his thumb on the scale and saying, hey, not only can you buy crypto, but you can buy crypto pre-tax. And the only thing I would say about that is the Trump administration and the Department of Labor can put out this guidance saying, employers, you're free to put crypto into 401k options for your employees. But as Corey said, employers are still fiduciaries to their employees for the purposes of selecting these 401k plans. So it remains to be seen if employers actually think that they can offer these options to their employees and still comply with the law and their responsibility to act in the best interest of their employees.
You know, two terms we hear a lot these days are stable coins and meme coins. We're going to discuss exactly what they are next. I'm Herb Weisbaum, the Consumer Man. You're listening to Consumerpedia, powered by checkbook.org.
Consumerpedia Fast Facts. Bitcoin was created in 2009 and is the largest and oldest cryptocurrency. Bitcoins are continually created through a process called mining. The maximum number of Bitcoins that can be mined is 21 million. Currently, there are approximately 1.3 million left to mine. It's estimated that a significant share of mined Bitcoins, about 15 to 20%, is permanently lost due to forgotten passwords, discarded hard drives, or lost private keys. The IRS treats Bitcoin and other cryptocurrencies as property, not currency. That means transactions involving Bitcoin are subject to capital gains tax, just like transactions involving stocks or real estate. Crypto holdings and transactions must be reported on your income tax form each year.
Two other things I want to touch on before we go, stable coins and meme coins. A stable coin, as the name implies, is any digital currency designed to have a relatively stable price. How does that work?
A stable coin is a crypto dollar that claims that it can be exchanged for a US dollar at any point in time on demand, like you would go to a bank and demand to get your money out. What you do when you purchase a stablecoin is you give your US dollar to a company. They take that US dollar, give you a crypto dollar in exchange, and then invest the money that you provided them in a basket of assets. And that basket of assets can include treasury bonds, stocks, other types of bonds. They could put the money in a money market fund or in a bank account, including uninsured bank accounts. And the stablecoin company earns and keeps all of the returns on those investments, but promises you that you can get your dollar back at any time. So what's in it for the stablecoin company is obvious. They get to take people's money and make a return on it, and they don't have to give any of that return to the customers. But what's in it for the stablecoin customer is that they get this crypto dollar to play with in the markets.
And people are supposed to use stable coins for everyday transactions like movie tickets, concessions at AMC theaters and Regal cinemas. They'll take them to buy computer products at Newegg or make payments through Shopify. I don't know why anyone would do that. Corey, do you see any reason why I have to change my dollars to stable coins to go back and buy something? I could give them my dollars.
It really is a nonsensical notion. Again, it is one of those promises from crypto that does not hold up to reality. The claim of stablecoins is that they create this new high technology infrastructure for payments. And the fact of the matter is, we saw with the legislation passed in Congress that because stablecoins couldn't compete on their merits, because they weren't getting adoption, this legislation was passed that will end up giving them access to what are called Fed master accounts. And essentially what that is access to the payment system, the public payment system that we already pay for, that we created decades ago, in order to get their crypto tokens into the real economy. So what they're really doing is sort of vampiring onto infrastructure that we've already created and we've already paid for with this false promise of updated, more efficient technology.
Is this the Genius Act that President Trump signed into law in July?
Yes.
So that now basically legitimizes stable coins for use in commerce.
It is essentially an endorsement of stablecoins, and it is a deregulation of all of the laws, the consumer laws, the financial stability laws that apply to every other type of payment. In fact, one of the reasons you're seeing PayPal, Venmo, MasterCard, Visa all start to move into stablecoin products is because they are currently subject to all of those regulations. But now if they move into stablecoins, they don't have to offer those protections. They don't have to do the same kind of compliance.
And then there are meme coins. They're basically a novelty, but they can increase in value. Dogecoin is the original meme coin. It was launched back in 2013 as a joke. And now President Trump and Melania have meme coins. So do Caitlyn Jenner and Iggy Azalea. Amanda, how do you feel about meme coins?
Look, to a certain extent, all cryptocurrency is meme coins because they're all backed by sentiment, avatars, stories that people tell, and not future profits or an enterprise with a real business model that may or may not grow. But this recent advent of meme coins is really something in that the purveyors of the meme coins don't even purport that maybe one day the underlying token will have value in some sort of blockchain system. They freely admit that it should be treated like a digital trading card, except at least with trading cards, people get true collectible joy from them. They can display them. Whereas with these meme coins, it's really just a way for the promoter to make a ton of money banking on their likeness, their image, their popularity, their fan base, or political power, and get users to give them money for something that has no real value except the slight promise that the tokens might appreciate one day.
Final point, and it's a really important one. Crypto is becoming a favorite way con artists convince you, the listener, to send them money for all sorts of bogus reasons that sound scary in the moment. According to the Federal Trade Commission, scams involving Bitcoin ATMs, quote, have surged dramatically in recent years. Tens of millions of US dollars are now being converted to digital currency and sent to the fraudsters. And the widespread access to Bitcoin ATM machines across the country has been a godsend to these bad guys. The FTC calls them, quote, payment portals for scammers, a really serious problem. We need to tell people if someone is telling you to go to an ATM machine, put money in, and send that money to me in the form of Bitcoins, I think you need to run as fast as possible, right?
Absolutely. And fraud involving Bitcoin ATMs is some of the fastest growing cryptocurrency fraud. It is affecting older Americans disproportionately. And look, a lot of people have heard about past scams where scam artists would call folks and demand iTunes gift cards or Visa gift cards. This is just the updated version of that scam, but instead of sending somebody to Walgreens to buy $500 worth of iTunes gift cards, they're directing someone to the nearest Bitcoin ATM to funnel money to them. This is not hypothetical. Local law enforcement agencies are really struggling with this. Illinois just passed a law related to Bitcoin ATMs, and a lot of state legislatures are looking at this. So folks should really be aware that if anyone is making a time-rushed plea for them to go to a Bitcoin ATM, to really steer clear, and frankly, to steer clear of Bitcoin ATMs generally, because they can charge up to 22% fees.
Oy.
It's just a very troubling trend.
And by the way, if you think you've fallen for a crypto scam, contact the FBI's Internet Crime Complaint Center at ic3.gov. That's ic3.gov. This has been so enlightening. I want to thank our wonderful guests, Amanda Fisher, Policy Director and COO of Better Markets. You'll find them on the web at bettermarkets.org. Thank you, Amanda.
Thank you so much.
And Corey Frayer, Director of Investor Protection at the Consumer Federation of America. You'll find them on the web at consumerfed.org. Thank you, Corey.
Thanks for having me on.
Before we go, a couple of other Consumerpedia podcasts you might want to check out. Number 88, Cyber Thieves Weaponize AI to Perfect Online Scams. 81, Algorithms Secretly Control Your Financial Fate. And number 11, How to Protect Yourself from Identity Theft. And with that, we're out of time. We hope you'll rate this episode. It's really helpful. And follow us on Apple Podcasts, Spotify, or wherever you listen to your podcasts. Remember, we release new episodes every other Thursday. Another way you can support this show is to follow us at Consumerpedia on Facebook and Instagram, at consumerpedia.org on Blue Sky, and at My Consumerpedia on X. You'll find me at consumerman.com. I'm Herb Weisbaum, always looking out for you. Until next time, be smart and shop wisely.
Consumerpedia is a public service of checkbook.org. We're a unique nonprofit that helps you save money and make smarter choices. You can count on Checkbook to help you find the best services and avoid the worst, with local ratings that are accurate and unbiased. If you live in or around these 7 cities and haven't joined Checkbook yet, check us out. Boston, Chicago, Philadelphia, Minneapolis-St. Paul, Seattle, San Francisco, and Washington, D.C. To get your free 30-day subscription, go to checkbook.org/Consumerpedia. Consumerpedia, empowering consumers to save money and make smarter choices.